Hey Fools, Brendan Mathews here. I'm joined with Jason Moser on our Ask a Fool segment. We've got a great question. It comes from Nonsense713, which is a Twitter handle, I believe.
Yeah.
So Jason, the question is, how can we truly know if we are diversified?
It's a good question, a bit of a philosophical endeavor here, I guess. But I think it helps to understand for any investor what stage of your investing life you are in. And what I mean by that is most investors are either in the stage of growing their wealth or they're in the stage of protecting their wealth. And so younger investors can focus on growing their wealth. And I think that as you get closer and closer to retirement, and then in retirement, you're focused more on protecting your wealth.
So do you want to be more diversified in order to protect your wealth?
I think that it certainly helps to be diversified in either case, but I think it's the form of diversification that really we want to examine here. So let's look at someone who's maybe growing their wealth. And you know, we obviously recommend and cover a lot of stocks here at the Motley Fool. And I think if you're looking for like the ultimate diversification, take an S&P index fund, for example, that's going to give you exposure to all 500 companies within that S&P index fund. And that gives you really the ultimate diversity in size of companies and markets and sectors. And so in theory, that would be ultimate diversification right there. And you can achieve that just by investing in that S&P index fund. Vanguard, for example, has a great S&P index fund. When you get towards that protecting your wealth, and something, you know, I always look at our great retirement service here, Rule Your Retirement, thanks to Robert Brokamp. He has some excellent guidelines there for folks who are 10 years or further out of retirement, folks who are getting closer to retirement, and then folks who are actually in retirement. And so the closer you get to retirement, you want to see that portfolio start allocating more and more money towards bonds or other sort of fixed income style investments that are more protective. So for someone who's early in retirement, for example, they may want to see about a 50-50 split there of stocks and bonds. And as you get older and older, you need to focus more on protecting that wealth and going more towards those lower risk vehicles. But ultimately, it's a question you have to sort of discover on your own in understanding your risk tolerance as an investor. I think some people can tolerate risk more than others. And so that's the question you have to really answer. Then once you understand the stage of your investing life and your risk tolerance, I think that helps you understand better how diversified you really need to be.
Okay, that makes sense, Jason. Let me ask you this. So a lot of people, when they think about diversifying, they think that they need to own international stocks. What do you think of that theory?
So, I think 20 or 30 years ago, that was probably a more valid point, and that we would seek out those international companies. But today, thankfully, the internet has really made the world a smaller place. And what that means is we have all of these companies that we see as American companies. They are really global endeavors. I mean, think about McDonald's and Coca-Cola and Apple and companies like that. Yeah. They make a lot of their money overseas. And so I think that you can gain tremendous international exposure by just focusing on finding those types of multinational companies that we know are still relatively low in risk because they're big, they're established, they have great histories behind them. In many cases, they pay great dividend yields too.
Great. Thanks, Jason. That's our Ask a Fool segment. For more, check out Fool.com.